Hello, in this video, we'll discuss how accountants analyze business transactions with the help of T accounts. In prior videos, we learned how to analyze business transactions using the accounting equation, assets equals liabilities plus owner's equity. And we recorded the 12 initial transactions for Eli's Consulting by entering the amounts in the accounting equation table. But another tool accountants use to analyze business transactions is the T account. The T account is an important visual tool used as an alternative to the fundamental accounting equation. And just like it sounds, T accounts look like a T with the name of the account above the horizontal line. And the left side is called the debit side, and the right side is called the credit side. It takes a bit of practice and repetition, really not unlike a foreign language, to remember what accounts increase with debits and decrease with credits, and what accounts increase with credits and decrease with debits. But for now, remember that assets increase with the debit on the left side. And it might be helpful to remember that assets are also on the left side of the balance sheet. Assets decrease with credits. Liabilities and owner's equity increase with the credit on the right side, and these accounts are also located on the right side of the balance sheet. Liabilities and owner's equity decrease with debits. Here's a visual look at assets, liabilities, and owner's equity accounts and how they increase and decrease. Assets increase with debits on the left side and decrease with credits on the right side. Liabilities and owner's equity accounts increase with credits on the right side and decrease with debits on the left side. So what does it all mean? It means that if your business transaction increases an asset, then your transaction must include a debit to an asset account, such as cash, accounts receivable, equipment, prepaid expenses, and supplies. Just keep in mind that every transaction must have at least one debit and one credit. And the accounting equation must still be true after the transaction is recorded. So if your transaction has a debit to an asset account, then we still need a credit to another account. There could be another asset or a liability account or an owner's equity account. So let's practice this a little bit with a business transaction. Here we have a transaction where the business purchased a used car for the firm for $16,200 in cash. And even though it says cash, it likely was a check from the business bank account. When you're working as an accountant, you would receive the sales contract that shows all the details of the car purchase, and you would see that the bank account decreased by $16,200. So let's analyze this transaction. What do we know? We know that the bank account or cash decreased. And what kind of account is cash? That's right. Cash is an asset. And assets decrease with credits. But remember, every transaction has at least one debit and one credit. So we have a credit, but we still need a debit. What else happened as part of our transaction? That's right. That the business now has a car. The car is an asset to the business. And in the table up above, we can see that assets increase with debits. We can now enter the transactions in a T account. We always start with a debit, so we can enter $16,200 as a debit into the T account for cars. And we're now ready to enter the credit into the cash T account, $16,200 on the credit side. Visually, you can see that the debits of all T accounts are $16,200 and that the credits of all T accounts equal $16,200. Now, when you're analyzing a lot of transactions, a way to keep track of that you're still balancing, meaning total debits equal total credits, accountants prepare a trial balance. But we'll talk more about that later. Let's look now at the first 6 transactions of Eli's Consulting and analyze those transactions with the help of T accounts. In the first transaction, Trayton Eli contributes $100,000 in cash from his personal funds to the business. And when we analyze this transaction using the accounting equation, we said that the business's cash, which is property or assets of the business, increased, and that the owner's equity also increased by $100,000. How do we write this transaction using T accounts? Well, cash is an asset account, and we learned that assets increase with debits. That is why we write a debit on the left side of the cash account. The amount the business owes the owner also increased. We learned that owner's equity accounts increase with credits on the right side of the T account. So let's write a $100,000 credit into the owner's equity account. Remember that all transactions must have at least one debit and one credit and must always balance. Otherwise, our accounting equation would not hold true. And now with the first transaction behind us, let's look at the next transaction. Our second transaction, Eli's Consulting Services issued a $5,000 check to purchase a computer and other equipment. So our computer and other equipment increased by $5,000. And at the same time, Eli's Consulting issued a check, which means that cash decreased. Both accounts are asset accounts. And we can see here in the below graphic that assets increase on the left side with a debit and decrease on the right side with a credit. For this transaction, the equipment account increases. That means that we increase the equipment account on the left side with a debit of $5,000. Cash decreased. Cash is an asset, and assets decrease with credits on the right side. So we'll write $5,000 on the right side of the cash account for the second transaction. Eli's Consulting Services purchased office equipment on account from Office Plus for $6,000 for the third transaction. Our equipment account, which is an asset, increased. Assets increase with debits, and that's why we write a $6,000 debit on the left side. When a business buys on credit or on account, as Eli's Consulting did, we call that an accounts payable. So when we pay on account, accounts payable increase. Accounts payable is a liability account, and liability accounts increase with credits. Therefore, we write a $6,000 credit on the right side of the account for our third transaction. In the fourth transaction, Sanchez purchased supplies so that Eli's Consulting Services could start operations. And for this transaction, Eli's Consulting issued a check for $1,500 to Office Deluxe Inc. to purchase office supplies. So two things happened. One, the business now has more office supplies. And two, the business now has less cash. So let's start with the first part. Office supplies is an asset and increases on the left side with a debit. So we'll debit the account office supplies for $1,500. The second part of our transaction must therefore be a credit because all transactions have at least one debit and one credit. Each transaction must balance, and the first part of our transaction was a debit. So we already know that we'll need a credit to an account, but we can also look at our table. Eli's Consulting issued a check, so cash decreased, and cash is an asset, and assets decrease with a credit. Therefore, we're going to credit cash for $1,500 for this transaction. In our fifth transaction, Sanchez, the office manager, decides to reduce the firm's debt to Office Plus by $2,500. Eli's Consulting had previously purchased equipment from Office Plus for $6,000, and we're now reducing that debt by $2,500. That means that Eli's Consulting's accounts payables are going to decrease. What kind of account is accounts payable? Accounts payable are liabilities, liabilities increase on the credit side and decrease on the debit side. So we're going to debit accounts payable for $2,500 and thereby reduce the accounts payable. Every accounting transaction must have at least one debit and one credit entry. And we've already figured out the debit side of our entry. So now let's figure out the credit. We decreased our cash account and cash as an asset account and decreases with credits. Therefore, we're going to credit cash by $2,500. Let's look at the sixth transaction. Eli's Consulting Services issued a check for $8,000 to pay for rent for the month of December and January. Payments in advance for rent are considered prepaid expenses, and prepaid expenses are an asset of the company. So we need to debit prepaid rent because our assets, prepaid rent increases and assets increase with debits. And just like we did in the prior transaction when Eli's Consulting issued a check, we need to decrease our cash account because cash is an asset and assets decrease with credits. Therefore, we'll credit the cash account for $8,000. We've now recorded the first 6 transactions for November into T accounts. And we can calculate the account balances for all of the accounts that have transactions. So how exactly would we do that? Well, we would add the numbers on each side of the account and enter the sum in the small pencil figures called the footing. And in practice, it's not really done anymore because typically most businesses use software programs and the system will do that automatically. But it's good to practice the theory. So subtract the smaller total from the larger one. And then the result is the account balance. And the total is recorded on the side with the larger amount. And usually account balances appear on the increase side of the account. What that means is that, for instance, for assets, assets increase with debits, so typically that's where the balance would be. We refer to that also as the normal balance. So now let's look at the cash account. We had an increase in cash from the investment from Trading Eli of $100,000, and then 4 transactions that decreased the cash account by $17,000. Writing the amount of $17,000 is called the footing. Then we'll calculate the balance, which is $100,000 minus the 4 transactions that decrease the cash account for $17,000, leaving us with a balance of $83,000. We do the same for the other assets accounts, and you can see that the supplies account has a balance of $1,500. We don't need to calculate anything for this account because there's only one transaction. Same thing is true for prepaid rent. We can see that the balance is $8,000. For equipment, we have 2 transactions. So we'll calculate the balance by adding those 2 transactions together, and we'll do the same for the liabilities. We had decreases in liabilities of $6,000 and a decrease of $2,500, leaving us with a balance of $3,500. Next, we have the investment by Trading Eli as an increase to the owner's equity account. Once we have all of this, we can prepare the balance sheet. We don't have any other financial statements that we're going to prepare at this point because no other transactions impacted any of the other financial statements, such as the income statement or the statement of owner's equity. All right, so let's start with the header of the balance sheet. So our balance sheet header has, as we discussed in Chapter 2, the name of the business, the name of the financial statement, and the time period. On the left side, we have the asset listing of the cash, supplies, prepaid rent, and equipment. The assets total $103,500. On the liability side, we have accounts payable of $3,500 and owner's equity of $100,000. You can see that the liabilities and owner's equity also total $103,500, which confirms that our accounting equation still holds true. Assets equals total liabilities plus owner's equity. Accounting requires a lot of practice. Why not draw some T accounts on a piece of paper and practice writing down these transactions? In part 2 to analyzing business transactions using T accounts, we will enter the remaining transactions for Eli's Consulting into T accounts, prepare a trial balance, and financial statements.